Good morning, good afternoon, everyone. It's great to see you all on this session. We'll be doing a strategy update as we do every week. This is suitable for both institutional as well as individual LPs, family offices, and the likes. As many of you know, our investment thesis here in Helix is deeply connected to the ecoeconomics, which is what I wrote in my books. So if you'll understand how this works, it's a combination of companies that are very profitable and sustainable at the same time. But at the same time, what we also do is to take short positions on companies that are undergoing environmental litigation or they're dropping environmental targets. They are dropping climate targets, etc. So we take short positions on those. So we can call that as a structural short rather than a short-term short. One of the challenges that we have with a typical ecoeconomics kind of an investment strategy is that the moment a company has a sustainability section on their website, not even doing anything about it, just calling it sustainability and maybe a few words there, its share price goes up. That's the reality here, right? There is what we call as an eco premium, and that eco premium acts in two different ways. One side of this is there an edge that this particular company has over its competitors because of its sustainability related work that it is doing, right? This is one side of the eco premium. The second side of the eco premium is actually I would say the more interesting side of eco premium, which is how well are they positioned to manage the transition risk. And while the current US administration could say that there is no transition risk, there is no climate change, etc., etc., the reality is the financial market does not think so. The market thinks that there is a transition risk, and it has always priced this transition risk. We have been observing it for at least the last 6 years. It has always priced in transition risk. So how will this company is able to manage transition risk? So from those perspectives, there is a premium. So we might take a short position on some stocks which are actually eco leaders, but they are overvalued. So we expect them to reduce in price over the next few weeks, months, and then we would get in at a time when we are comfortable as an undervalued stock. We are comfortable and we are happy to get into a long position in that particular stock, right? Now, what is happening in the last 1 or 2 weeks, and what is the sort of update that we have for this week? Now, looking at what is going on in the US market, this is like a high school girls fight, right, between Donald Trump and Elon Musk, right? It reminds me of what used to happen. I call it girls fight, but I shouldn't be saying girls fight. It's basically like school kids fighting over something, right? So this kind of a flip flop in the market, this kind of a flip flop in policy that Donald Trump has created, and his fallout with Elon Musk has provided a number of opportunities, right? So I see it as opportunity. One is Tesla themselves, right? So my concern with Tesla is when Elon Musk wanted to go and do this Doji business, the board of Tesla should have distanced him from all of its business, right? So he becomes a political risk, and the board did not do that. And for that, I think Tesla is taking a beating, right? So the stock fell, and with that, we took short positions. Right now, the stock is starting to recover, and we are looking at entering in long at some point, right? Now, this fallout also means that there are a number of other energy transition related companies, renewable companies, EV manufacturers that are all being hit at the same time. So, so we take strategic positions on these, and we use that as an opportunity to buy in cheap and hold that particular stock, right? So that way we are able to deliver a better return than other funds, in the sense that we are very oriented to what is happening in the market, and we are observing these trends on a sort of day-to-day basis and looking at how things are working. Now, if I look at what is happening in India, um, well, the markets have moved positively. One of the important factors to look at is uh, foreign institutional investors, foreign portfolio investors have been net sellers, and domestic institutions have doubled down, which means that the local confidence in the market is on the higher side. So, if you are a India focused investor, this is the time to get in, right? When a number of your peers who are foreign portfolio investors are, are coming out, this is just the right time for you to get in. So we are thinking of a India at 100 kind of a thesis. We'll talk about that very soon, um, in terms of how this is going to work. But this is something that I would suggest if you are looking at India long term, then this is definitely the time to get in. Um, from a currency perspective, the INR has gone to about 85.79. Um, Not too great, modest fluctuation, part of the normal currency sort of fluctuations, etc. Right? Then going into what is happening currently in the market, what is expected this week. Um, Japan GDP data came in earlier yesterday, and then we had the the CPI information from China. So that's again vital in terms of how this is panning out. So one of the things that I've been looking at quite recently is that this trade war with China, who is the beneficiary out of it? I think the beneficiary is China, right? Uh, and there's actually reasons why I say that, right? While the US has been outsourcing its manufacturing capacity, and China has taken a lot of it. China is not completely US dependent. China has 80 plus trading partners that they can go to. If one trading partner, yes, the major one, is dragging its feet with tariffs and whatever, they can look at prioritizing 79 others, right? So, with that perspective, I think they are probably better placed than than the US, right? So, this tariff war in itself is misplaced, right? As far as I can see, it is misplaced. It creates unnecessary uncertainty in the market, right? Manufactured crisis, as they call it, right? There is no crisis in really, but this crisis is being manufactured. The US has some structural issues to solve. Number one that I can see is, um, I think the root cause of all of it is boiling down to the savings rates uh, going down year on year, and many of the tax cut policies, etc., in the US are basically rolled over by Congress. So based on its term, they basically just roll over. It is not budgeted, baked in for the longer term. So, uh, so from an individual standpoint, if it gets um, cut, then you see a benefit. If it cannot be rolled over, you see a tax rise. This is unnecessary, right? This is not the way a large economy should be budgeting. And uh, obviously, that is not how the UK is budgeting. This is not how various other larger G20 countries are doing their budgeting. US has its ways of working. It has helped so far, uh, but the buyers of debt uh, are the ones that Donald Trump has basically antagonized. Right? China is a large buyer of US debt, and you want to burn bridges, you want to make a deal with China, right? You want to burn bridges with that. Sorry, Donald Trump, you haven't had a deal in the last 100 days of your presidency. You haven't had any deals, right? Are you going to have a deal in the rest of your presidency? Probably not. Better to kind of take things as it is, draw a line in the sand, work with trading partners more favorably. I think that is better for the markets. Now, coming to UK, um, we've got unemployment trends that came in earlier today. Um, the while the sort of labor market figures are will be closely watched, for our signals, etc. Um, and also for the Bank of England's monetary policy stance. What I would like to talk about here is a bigger problem underneath, which is underemployment, right? That is not going to show up in any of these statistics. The reason why I say that is uh, as we survey a number of young people under 30, what we find is um, soon after they graduate, they are looking for opportunities, and quite often they are not getting the opportunities that they deserve for their um, qualifications. And it so happens that there is underemployment in the market. While they seem to be in employment, it's not in the correct employment. So from an earning capacity standpoint, you're a bit down, right? And this continues for a few years before they are able to get into um, the kind of right positions. Sometimes, what is the right position? That itself is a question. So, there is obviously this uh, gap between what the education system produces, churns out, versus what the employers want. And progressively, not many employers have invested in capacity building, like apprenticeships. There is a mechanism called apprenticeship by which you can bring in um, a sharp individual, maybe straight from school or from college, or in some cases from uni, train them for a few years, and that means that they are able to understand the business in a much better way. But not many employers sign up to it. Not many employers take up the apprenticeship routes. There are internships available. uh, Not many of them add a lot of value, right? From a learning and value add perspective, there's not a lot of value being added by many internships. So uh, that's the situation. That's the real situation on the ground. On one side, there is um, a policy favoring more of the older people and their savings, the pensions, etc. most of the policy is favoring that. But for you to meet that policy, you need more younger people coming into the workforce. We don't have policies to favor that, right? Since we don't have policies to favor that, it is left to the whims and fancies of the individuals and the companies in order to act on that perspective, right? Uh, with that in mind, if we essentially look at the sort of skill gaps, almost every employer, two-thirds of employers report skill gaps. What are they doing about it? Literally nothing, right? Um, they expect the government to do something about it. And obviously, the government is too busy doing something else, right? So you've got a situation where assets are becoming more expensive, policies are favoring the elderly. Those policies themselves need to be funded by younger people coming in to the workforce. There isn't a lot of effort being taken by either party, by the policy maker or the employers, in order to bridge that gap. So you have a large aspirations gap in the market. So whenever you find an employer that meets the aspirations gap, meets my aspirations, people are likely to stick with that employer for a much, much longer time frame. Whenever you find products and services that meet this aspirations gap, people are likely to stay with that particular product or service for a very long time. That, in effect, is the core of ecoeconomics. So that aspiration is digitally interconnected and is sustainable from the younger generation's perspective. The older generations not much oriented towards being digitally interconnected or sustainable for that matter, but you will understand that any person under the age of 30 is expecting this as part of their experience. So tomorrow in the US, we will be getting our CPI data, and we will also be getting the PPI, Producer Price Index, on Thursday. On Friday, in the Eurozone, we'll be looking at the harmonized index of consumer prices. So this should kind of give us where inflation is likely to go, though inflation only looks at products and service inflation, not really the asset inflation. We talked about it in the last few sessions. So we will have a little bit more information around that. Uh, from a earnings perspective, you're watching a number of companies. I'll talk a little bit more about it in the next session. What we're looking for is resource efficiency, circular economy principles, social equity, fair labor policies, etc., resilience to the climate risks. So these are all indicators what we expect. Our thesis in the context of the markets currently and how we are trading this week and going forward. Number one, we're looking at rising inflation. So how is this going to work? Particularly the core inflation. It can highlight the strain on the global supply chains, and it can potentially signal a resource scarcity, manufactured scarcity, right? Uh, our thesis emphasizes the need for a local and resilient supply chain. So those companies that are able to tackle this, we are likely to take bigger positions on that. Domestic resilience and the respective economies that we are tracking, right? That's going to be very, very important. The US, UK, Eurozone, India, Japan, right? We're going to be looking at these policies and the sustainability indicators from that. While central bank decisions influenced by the economic data. See, I tell you what, a lot of the economists are a little bit, I can say, elitist, right? In the sense they would look at the data that is coming in and they would make assumptions on that. Whereas I and Helix, for instance, we look at what is happening on the ground. We look at what is happening in the market. So our readings are quite different from what you get from the economic powerhouses like the central banks, etc. We are looking at it more practically, looking at how companies' earnings are getting impacted by the tariffs, etc. We want to watch that and we want to take positions based on that, right? We observe normal market fluctuations. I can say right now it is 99% noise, less than 1% signal, right? So eliminating all of that noise and then focusing on potential volatility that we get and the key economic data that we are looking at, consumer prices, inflation, uh, as well as unemployment, underemployment that we are looking at. I think our economics thesis remains intact, robust, and resilient. We continue to believe that the long-term value creation is increasingly tied to businesses and economies that prioritize this financial and environmental, social sustainability, right, together, right? So this triangular relationship, both at the business level and the economy level. So if it has to happen at the business level and the economy level, that also has to happen at the individual level as well. So from a consumer, from a worker standpoint as well, that triangular relationship works really well. So we'll continue to analyze these trends. We'll continue to update you. Now, I'd like to invite you to comment. Please feel free to comment on our post, or if you'd like to message me, you have a message button right there. Just click on that and send me a message, or you can also reach out to me on LinkedIn. I look forward to hearing your views. Thank you.